Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's July 25th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. Just came back from the Sprott Resource Conference in Vancouver. It's a real short trip for me, going to Florida to Vancouver from the Jacksonville airport, which it's not a direct flight. Basically flying the whole day there, a whole day back, and coming back, it's even worse because if you have the time change, I mean, you can leave at 9 o'clock in the morning and you're getting back at like midnight with the time change, no matter what, and a layover and stuff like that. It's pretty crazy. I love Vancouver. Beautiful city. Resource capital of the world. I was there for about a week. A lot of companies, CEOs, analysts, friends, and a few interesting observations. Surprising. So the Sprott conference, the traffic this year was down 55% from last year. And I've met at least with, more than a dozen CEOs, maybe close to 24. And people I see a lot, and just a couple, just every hour it was like another meeting, just getting updates on everything. And I have to tell you, every one of them, every one of them was negative, or maybe I should say, just not optimistic, which is a first for me covering this industry for a good 7-8 years. You usually hear them say, well, the cycle's going to turn. The last time this happened, this is why it's going to happen now. And all, it's getting to the point where, most of these guys are just shaking their heads. Some of them said, I don't know what to do. I mean, they added ounces. They did everything they said they were going to do over the past couple of years. The stock's trading lower than, some of them quadrupled their ounces on the books, high grade, great discoveries, and their stock's trading lower today than it was like 3 years ago, 2 years ago. I mean, much less ounces. They have cash on the balance sheet, so they're not going to have to raise money. They have great projects, strong management teams, yet their stocks are down, around 60% plus, especially over the past couple of years. Got a little bit of a head fake in early 2016, but then, boom, it came right back down again. And even more of a head fake was, Trump getting elected was the biggest supposed to be one of the biggest catalysts, all this uncertainty. And the sentiment was going in, Hillary's not so good for resource stocks. Trump winning would be a boom. And the exact opposite happened. And we've seen this industry get crushed since Trump's been elected. And like me, they're saying, well, I don't know what's going to turn this around. I don't know what's gold, silver. I don't know what's going to drive it higher. We've seen every market condition over the past 5 years during this brutal bear market. Again, outside the little time frame in 2016, market surge higher. And inflation we had deflationary condition. We had a rising dollar, higher dollar, lower dollar, interest rates going high, interest rates were low. Brexit, Italy recently, store value, state, all these conditions, if you look, pretty much existed. And what happens? These stocks haven't reacted. Gold prices are coming down even further now. I mean, it is cyclical, and usually these markets just change when nobody believes they're going to change. But when I see all these CEOs, I'm talking about everyone, guys. I'm not being selective here. I'm not trying to tell you the story. Again, I'm not a person that's going to tell you the story that fits my thesis. I hear things, get my information, and then form a thesis on different stocks and things I'm going to recommend. That's how I've done great, and that's how come I've been doing this for over 25 years. And if the conditions change, I change. And if that means I may not be bullish, I may not be bearish, but the conditions dictate that. And right now, these conditions what does it tell you when I see these things? We are pretty close to a bottom. And I know you've heard that before and say, oh, I know I've gotten burned. And yes, we've stopped out of some of these stocks because the risk reward seemed to be extremely favorable. But you saw in 2016, when the cycle turns, it's 3 times, 5 times, 10 times gains, which we saw in a lot of stocks. And you're going to risk 35% on most of these names on average in my newsletter, Curzio Venture. But what happened? We still see the market coming down. It's weak. So I know it's skeptical, but I'm just the things that I'm seeing where sentiment, at least from my perspective, again, someone who attends at least 2 to 3 resource conferences every year, speaks at most of these, but sentiment has never been this low. And in fact, nobody's interested in resource stocks to where Sprott, one of the biggest brands and money management firms in the space, sees a 55% decline in traffic at their signature conference year over year. It's kind of a positive sign to me. I mentioned a lot of new resource ideas on my Frankie Speaking podcast, which I host every Friday. You guys can download it on a different feed. Just go to iTunes. I also mentioned that I talked to a top uranium executive who took me flying in his plane. Went over Whistler, which is beautiful. The Vancouver snow-topped mountains and waterfalls, which are flowing into these big lakes. The lakes were turquoise from the minerals just coming off the mountains. I mean, even flying over the city, it was breathtaking. It was really breathtaking. Just beautiful. I should post a lot of these pictures. I did post on my Facebook page of me flying the plane for like 30 minutes, which he let me do. First time ever. And I told him, we discussed it. I was like, all right, I don't want to land it. I got to land a plane. He's like, I got to land a plane. I was like, come on, let me land it. I was getting really cocky because it's kind of easy. It's like a video game. Trying to plane. A very smooth ride. It was just, it was different than I thought it would be. I thought it'd be more rocky and it was very easy. The landing was easy. Taking off, you get up in the air in like 2 seconds. It was really cool. But I was looking forward to landing it. Again, first time I never flew a plane. I'm tired. Let me land it, which is funny. And he was like, no. And now that I think about it, for all of you lifetime members, I think you would have been really pissed off if I tried to land it and I crashed. I mean, I could see those emails coming into my family like, oh, so sorry for your loss. We love Frank. Can we get a refund since your husband was an idiot? So, good thing I didn't try to land a plane. But it was a lot of fun getting out there. It's really cool. And I also had a nice boat ride with the CEO of a mining company. He's also a good friend, and he's a beautiful boat. It's like a speedboat. And it was just the two of us, and we were in downtown Vancouver. And he's like, let's go to lunch. I said, yeah, that's great. Take the boat. We went to West Vancouver, and it's like a 15-minute trip and beautiful outside. And it wasn't just that day; it was beautiful. The whole week I was there was just, it was amazing. Even the plane ride, blue skies, just unbelievable. Got very lucky. But, 15-minute trip by boat from downtown Vancouver to West Vancouver. But if you take a cab, it's 45 minutes. Now, ask me, how do I know that, right? Since I took a boat there, how do I know it's a 45-minute cab ride to get back to downtown? Because, there was traffic. And I know that because when we pulled up to the dock, again, we docked the boat, small floating dock there, and, we got off and went to lunch, had a few beers, some great food, and after 90 minutes, I'm like, okay, I got to get out of here because I had a meeting with Keith Newmeyer at his office, who's the founder of First Majestic Silver, First Mining Finance. So, I had to get out of there. And we leave the restaurant, which was a really beautiful place, by the way. It was great. Lunch was great. Food was great. But he forgot, one little important point when he docked the boat. You see, he thought the tide was coming in, but to his surprise, the tide was going out. So when we got to the boat, it was actually sitting on land. It was on land, right? It was, docked the water. We got out. It was, and people were laughing, taking pictures, and we got out and we see his boat actually on land. The tide was low, and then it was low tide, and then his boat is just, I wasn't laughing. Everybody else was laughing because I had a meeting to get to, and then I just actually, I did take a step back and was laughing a little, but he was like, FNL, my boat, it's my terrible Australian accent. And, I was just laughing. And since this person is a good friend, he's just a really funny guy. It's just, it's just the fact that happened was just so funny. Everyone's taking a picture. But, he had to wait probably about 8 hours for the tide to turn to drive, his boat back home. Anyway, I was able to meet Keith Newmeyer, which, I'm glad I warmed up to, some beers first before I actually get there because, Keith is a tequila guy, hardcore, always has the best tequila in the world in stock and always makes me drink some every time we meet. So, so I made the meeting about 30 minutes late. Keith was cool with that. And we had a great meeting to the point where I think his company, First Majestic Silver, is pretty exciting. I mean, they reported record production recently. I think it was like 2 weeks ago. Nobody cares because, resource industry. The company's in the best shape ever in terms of production fundamentals. I know Keith personally. He knows exactly when he's cutting, at what price silver goes down, of what he has to do in terms of his mines, Mexico, things like that. I mean, it's pretty incredible that you talk about someone's been in this industry for over 3 decades who understands the ups and downs where you don't have a new CEO going, what do I do? The market's still coming down. Do we raise money? Do we do this? It's a lot different with Keith. I mean, he's been through these boom and bust cycles, and the fact that he's ahead of the markets all the time is really cool. But the company's in the best shape ever in terms of production fundamentals and Yeah, it's just down along with the rest of the market. Maybe not be a buy right now, but if you do see a little momentum in the sector, which is going to bring everything higher, the cycle change, this is probably an easy double or triple right away. Just the fundamentals there. It's a really good company. Anyway, point of this story, right, is I always get questions on how I build my network, especially from younger listeners. And I'm fortunate to have, a huge network, great network, people that I've interviewed, also you listeners where, podcast base keeps building and building and building, which I'm always humbled by. And, there's so many brilliant people out there because I'm a believer that people are brilliant in just different areas. You guys listen to me to try to teach about stocks, but you guys are great in so many different industries and have your own companies and been working in certain places for a long time. I even have millennials emailing me about the latest trends, the latest apps, latest technology, which, you have to keep ahead on, right? And that's someplace where you can make a lot of money because the biggest investors in the world don't really understand technology all that well. If they did, I think everybody went into buying the FANG stocks probably a long, long time ago. But building my network, it's not just going to conferences. We call it being in the room, boots on the ground, traveling the world, visiting manufacturing facilities, which, I report back to all my subscribers on. But when I do meet CEOs and executives, I try to have fun. I mean, don't you think it's better to talk about uranium with one of the leading uranium executives in the world on his plane than a stuffy office, right? That's a memorable event. It's better to hop on a boat and talk about gold and new ideas with an executive instead of, in a lobby where the conference is being held, where people are just going to be walking by and some people might know him, some people might know me. You get interrupted. Even with Keith. I mean, it's great going to this office. I know I'm going to have a couple shots of tequila. It's 3 p.m. Vancouver time. I'm talking about the silver markets, the U.S. markets, new ideas. A lot more fun and relaxed compared to going to, one of those small conference rooms that you have at conferences where, they have a water cooler in the corner and you have a 15-minute time limit to where the next meeting starts and someone knocks on the door, you finish. It's kind of like speed dating at investment conferences, right? Yeah, you have 10, 15 minutes to meet, every CEO of the conference and then choose whose number you're going to get to hook up later, right? to build your network and stuff. But it's much better to do something fun, memorable, because that's how you build relationships, right? I mean, it's not often you could say you went away last week, drove a plane for the first time, got stuck on a boat on land and had tequila shots. One of this, CEOs, one of the top silver producers in the world. That's just 3 of probably, more than dozens of meetings or dozen meetings. I have to tell you, out of those 3 meetings alone, I'm not just talking about their companies, but I got at least 7 or 8 new ideas. Again, not related to the actual companies they run because these guys are always investing in new ideas. They have amazing contacts and big networks themselves. Right, just like myself, when they ask me, what I like, what's going on with the U.S. markets, and I tell them. Give them some of the things I recommend in my newsletters, some of the sectors, things I'm seeing. Yeah, they ask me about the markets all the time. Like when the FANG is going to crash, and that could be good for us. And I say, don't hold your breath. I mean, since they have the keys to the kingdom, access to what everyone in the world does every single minute of the day, and it's going to get even more accurate as 5G comes out, speeds improve, algorithms are going to get more advanced. And unless companies, every single company in the world just decides to stop advertising, which is never, these companies are going to continue to see incredible growth and generate massive profits. We just saw Google report, right? Unbelievable. You see Facebook report strong numbers. These companies to continue to report great numbers, growing tremendously because they have the keys to the kingdom, and no one could really get into that space other than, the FANGs. You're disrupting all those industries. And again, it's about data collection. It's about understanding just how to read these numbers. And again, is there privacy issues? Yeah, there's privacy issues, but more important, they're just looking to how do we bring the products that you like to buy to you as fast as we can, the best discounts. And, they have a significant advantage over other advertising platforms because, again, if you have a product, you want to sell it to everyone who's bought a product similar to yours. You don't want to, waste your money. How much money gets wasted when you're advertising if you put a commercial on TV? I mean, it's got to be 80%, 90% of the people that probably aren't even that concerned with your product when you do it on TV. But, when these people are posting that, state golf, for example, they go golf every week and they have pictures all over, Facebook, and they're posting on Twitter and, they're posting, Pro V1s or whatever. Now, that's titleists can come in and say, hey, I want to advertise. Well, these are people that are actually, we know that are using your products. Here's 3-4 million of them. Here you go. I mean, you can't beat that, right? So if you look at the FANG stocks and you're being honest with yourself, you think they're overvalued, you think it's crazy, but they continue to put up those growth numbers, and they're going to go higher, which I've been saying for at least 4 years now. I'm saying go all in and buy them at these levels, but continue holding them till you see something breaks, but we haven't seen it. I mean, the growth is there. Man, percentage-wise, I think Facebook's growing faster on a percentage basis, which is amazing in earnings. It's just incredible. But these guys, I let them know about stuff like this because they don't follow this. They're strictly following resource stocks. But anyway, being serious here about the networking, just if you're going out, don't just make yourself available. It's a lot more than that. I mean, have fun with these guys. Do your research on them. You can easily find out what they like outside of the scope of their business, like planes, like boats, like tequila. It's not hard. These guys get interviewed a lot. You can go and look at their profiles. They like talking about that. If someone's going to talk to me about basketball, I'm going to talk to them forever about it. You want to, I'm going to remember you, which is the most important thing. And find the passion that they love. And believe me, not only are you going to have a great contact, but you're going to establish a really great friendship. And that goes a very long way. And that's, one of the ways that I build my contact list. Like you'll hear, oh, that guy Frank, he's crazy. He has fun. He does this. It's not just going, meeting these people and, picking their mind about business, which thousands of people do, and analysts and sell-side analysts do. It's more than that. Get personal. Talk about your families. Because once you establish that, you have a good contact, you have it for life. And it's an honest contact. It's someone that's going to care about you. It's someone that's going to give you good advice. They're going to tell you when to buy things, when not to buy things, compared to the person, the CEO, which, again, you always interview CEOs. I interview CEOs, and they're always going to be bullish on their companies, just like you guys are bullish on your companies. It's very rare you go to CEO and they're like, don't buy my company. The resource guys are nervous right now, but they're not saying don't buy my company. When you really have friendships and things like that, they'll tell you, well, yeah, I'm not too crazy about this. I'm not too crazy about that. That's how you build a really, really good network. Not just going out and being in the room and meeting these people, but going out of your way, learning about them, doing something fun outside of the scope of business. That's how you establish those really, really good relationships. And for me, it's how I find my best ideas through my network, which includes all of you. So just feel free to email me, whatever, frank@curzioresearch.com. That's frank@curzioresearch.com. Now, great interview for you today with the second best analyst I know. That's Mike Alkin, one of the best short sellers out there. And that's not me talking. I mean, that's among the hedge fund community. He also has a track record to prove it. Mike is editor of Moneyflow Trader, Curzio Research, and it's just really an amazing newsletter, especially for individual investors. And the product is unique because it shows you how to make money when stocks fall. It's unique because it limits your risk while doing this, where you're not actually shorting stocks, which I don't recommend for any individual investor. Okay, that's for professionals. Because when you do that and actually short stocks, you have unlimited risk. Since the stock can go at 500, 1,000, 2,000, you can really get destroyed. But Mike uses conservative option strategies for stocks where you're betting that are going to lose value over a 12-month period. And it's very conservative. It's very easy to use. And it's, he has a whole entire book of how to actually, that he wrote, and a whole manual. And, so everyone that's subscribing is really learning this system, and we're getting very positive feedback. But more important, Alkin's doing pretty good right now. He closed out 2 positions for triple-digit gains, or pretty close to that. Several others right now in the portfolio are really strong buys, where he's down a little bit in positions where he took a quarter position. And I think right now is a perfect time for this newsletter where subscribers could make an absolute killing. And for me, and I mean this, is I love pushing our products during the right times. And we launched a crypto product where we could have launched this product when Bitcoin was at 15,000, right? Say in November, December, January, like most of our competitors. So what does that mean? We could have sold the crap out of this product, and that may sound counterintuitive. Well, that's what you want to do. You're a business. Not necessarily. Not if you're looking long-term, which we do here, because we knew that was an inflated market. We were pretty sure it was an inflated market, that, regulation was going to come out. We have great inside access to this industry, just not inside that, just stuff that's available to the public, but we talked to a lot of our sources. And what's going to happen if you got into some of the crypto things if we launch like our competitors? Now you're sitting on massive, massive losses, right? You get subscribers that are pissed off. They talk bad about your brand. They're never going to subscribe to another one of your products. And most important, you just crushed new people who are coming into your company. And these are people that work hard for that money that just got nailed because you're selling a product at the absolute worst time you could do it, right? When all the hype is actually there. So I'm always careful on this podcast, bring on CEOs of companies when I think their stock is a strong buy, because in the past I did bring on one or two CEOs where I thought their stock was really a strong buy and the stock came down. So I'm always conscious of that. So if CEOs want to come on when their stock's up 300%, I'm like, nah, not really. I don't want you to really come on the podcast because people are going to get excited about the idea and they're going to buy it at the wrong time. That's my responsibility, right? Even when we're launching new products where I think subscribers can make a ton of money because the timing is right for the product. That's when we try to launch products. And even when we're marketing new products, existing products, we're going to do that when I think my listeners, you, can make a killing over the next few years. That's Moneyflow Trader right now, because it's a product that's going to kill it if the markets pull back, which you should expect. And we have 8 straight years of outperformance where the average bull market is about 5.5 years. And even better is you're looking at the current market, and a lot of people, I'm going to surprise you with some statistics here. You don't really need a down market for this product to work because you're betting against individual stocks. And you say, well, the whole market's up and we're near highs and it's amazing. Not every stock's near their high. In fact, more than half the S&P 500 is down, even though the S&P 500 is up this year. And if you look at 100 stocks in the S&P 500, again, pretty interesting stat, they're down more than 10% year to date. Think about that. For me, when I saw that and I really did the data and dug in, it was surprising, right? Because you're seeing stocks, I was hearing, it's all-time highs and things are great. And when you look at some of these names, and these are names you heard of. These aren't like these little small cap stocks aren't too. We're talking about Starbucks, Walgreens, Whirlpool, Walmart, Caterpillar, Comcast, Deere, MetLife, Broadcom, eBay, Kimberly-Clark. How many Dow components are in that list right there? That's just a few of them I pulled. And pretty amazing when you think about it. And Mike's able to find a lot of these companies that are overvalued, especially within certain sectors. He talked about how negative it was in the auto sector. Look at the auto earnings that are coming out, which are terrible. He made money on Goodyear Tire, which you close out of positions. But you're basically betting in this newsletter, and why I love it so much, is that you're going to see earnings and sales slow over the next 12 months for some of these companies. And all you really need to do or see with this product is these companies report one bad quarter, because they're going to get nailed at these inflated prices where they can go down 15, 20%. And the option strategy he uses, that could result in triple-digit gains in months. So when I'm looking at this portfolio, it's just set up. The timing's great. And the fact that we're getting so much positive feedback from Moneyflow Trader. Again, Mike already closed 2 positions. One was Goodyear Tire, and Anheuser-Busch, Goodyear Tire just mentioned. And both of those would need triple-digit gains. So, again, the cool thing is you have a full year for this trade to work out. So if you're a believer that the market's overvalued, it's going to fall the next 12 months, 24 months, you're going to make a killing on this product. And that's why I like it. And for me, I'm always trying to get people on products at the right time. And right now is a perfect time. So Mike's also going to break down the uranium sector to become one of the leading analysts of the entire industry. I mean, he's not a person out there, the CEO that doesn't have him on speed dial, just from the models and the things that he's doing in this industry. Now, remember last week, which is funny, I said the contrarian play coming back from the conference in Vancouver is to go short this sector. The contrarian, right? Not that it's the right call. I mean, the contrarian call has been to short Amazon for 10 years, right? And that's been a horrible call. So people who were listening to my podcast actually said, this is frankly speaking when I said this, actually decided to email Alkin and said, Frank said to short the whole uranium industry. It's not what I said. I just say it was kind of surprising to see how many people were kind of bullish on uranium. I have about 5% of my assets in uranium. I think it's going to go higher over the long term. But Mike is very passionate about this industry, and it was kind of funny because I thought he was going to drive down to my Florida office from New York to beat the crap out of me, since all these emails he was getting and things on Twitter and emails and stuff like that and texts. While like 11 o'clock at night, he's like, I'm going to debate you out of uranium. I was like, whoa. I was like, I'm bullish on uranium. I'm just, for me, I like to highlight the positives and the negatives of every story. So, I had to tell him and listen, I'm not bearish. I was just bringing up a point when it comes to sentiment. But you're about to see how passionate Mike is on uranium and on some of his current positions in his Moneyflow Trader newsletter right now. Mike Alkin, thanks so much for coming back on the podcast.
Hey, buddy. Thanks for having me, Frank.
It's now different, right? When you sit with Curzio Research, I remember before that I used to call you. Now I kind of hear all your ideas all the time. I get to see them. It's different when I'm interviewing now, a little bit, right?
It is. Totally.
So, One is I want to give you a shout out for your podcast, and I'm so glad that you're doing a podcast now. Talking stocks over a beer, guys. If you haven't download it because you're interviewing totally different people, right? It's just separate where you have hedge fund managers on there, portfolio managers, and all I'm getting is positive feedback. Right? Did you listen to this interview? And I'll get in this. So it's great, and I guess I wanted to get your feedback on doing a podcast because when I first did it, I didn't understand the impact. I kind of took it as a joke 10 years ago. And now when I see how many people actually listen and the massive network it creates, not just with the people that you're interviewing, but the people who are listening, who are fascinating, it's kind of amazing. I was wondering what your thoughts on it. Now you've been doing it for a little bit, a few months now.
It's really a totally new experience for me, Frank. For 20 plus years in my career, my job was to keep a low profile and not have anyone know who you are, just kind of go pick stocks and do your thing. And, this is being public is entirely different for me. And, doing a podcast, I have no idea what I'm doing. I have no media background whatsoever. So, it's been a learning experience. I do keep them. I don't intentionally do it, but, some of them run an hour and a half. One ran 2 hours. And, I remember you and I talking and saying, keeping it under an hour. And I'm really just time challenged. But, so the format of it keeps changing because I'm trying to experiment and see what's interesting. And interestingly enough, when I do mention on the podcast that I'm going to shorten it, I get a ton of emails or tweets that say, don't do that, keep it longer. Because I try and keep it educational. My goal is to help ordinary investors share whatever insights I have that might be helpful for them from my experience of doing it from the professional side. It's not for, professional investors. What I'm sharing, my insights, they know. So, but I'm learning the format. It's a trip. I get a lot of feedback. At first, I'll be honest with you, Frank, I would have some people reach out to me and complain about a few things, something I not said, but format or whatever it was. And, at first I'm like, hey, dude, I'm taking my time to do this. Like, it's free for you. And then, like, what, seriously? But it really has been, it's been a great experience, and you meet really interesting people, and I get really nice feedback. And that's why I'm doing it, to try and help, and again, my thoughts and my insights are not always going to be correct, but hopefully they're cogent and could, if it helps people, that's great.
I've never had anyone tell me either that your podcast is too long or you got to shorten it up. It's for me, it's kind of like you just find your own niche, right? It's kind of like you're getting feedback. You want to tailor to that feedback, but also like it is public, right? So you talk about being private, now you're public, but I do get some emails where they're like, Frank, and they'll give me like 6 stocks. What do you think about these 6 stocks? Yeah. And I'll look, and they're not even a subscriber. I'm like, you want me to come to your house and rub your feet while I give you analysis for that too?
Well, that also too, Frank. It's funny you said that, because Twitter too, right? You're out there, and my nature is to not ignore an email, not to ignore a tweet or something, but you get so many of them. The volume is there. And sometimes, if you ask my wife, she'd tell you I'm not the most organized person in the world. So sometimes you get them and you're busy. I might be traveling. I might be working on something, and something falls through the cracks, and, you feel bad about it. But yeah, I get a lot of those. What do you think of this stock, or what do you think of that stock? And, first of all, I don't know the person. I'm not a financial advisor. I can't give financial advice. I can't give individual financial advice. So, but you're open for all the world to come at you, right? So it is definitely different. It's something I'm adapting to.
Yeah, and it was cool because I saw that adaptation where I didn't think you adapted yet, because I think you were going to drive down here and beat the crap out of me, because you have become, and I'm being serious here, guys, where Mike has become one of the uranium analysts out there that the biggest guys in the world are listening to. And I think that's fantastic, where hedge funds and the biggest companies in this industry are turning to Mike with the research that he's been doing over the past, year, 2 years, really digging deep and going into the fundamentals, where a lot of people who are analysts in this industry are asking him for advice and are looking at your model and going like, holy cow, this is amazing. And last week I said that, on my podcast, going to Vancouver conference, that the contrarian play is probably to go short uranium. Not that I'm short, but I know everybody tweeted you said Curzio short now, and I was like, Mike, and you sent me a tweet like, "Are you sure?" I'll debate this, and I was like, Mike, I have about 5% of my assets in uranium. I'm just saying, I was just surprised that I heard so many people were saying that they were long uranium and they believe it's going a lot higher compared to not. And again, it doesn't mean that it's going to go low where everyone thought the contrarian play was a short Amazon like for the last 5 years, and look what that's turned out. But for me, I wanted to talk to you about the uranium market because it's something that I'm bullish on, but I was just curious to see at that conference. It was the one area that people were a little bit bullish on, but let's get your point of view, because when we spoke about it offline, you were saying, well, there's a difference between people talking about it and there's a difference between people actually investing in it, and the institutions aren't in yet, but it seems like they want to come in. Could you get to that point and talk about why you like uranium so much?
Yeah. Well, first of all, you really screwed up my Friday night because I'm at I'm at our next door neighbor's barbecue, just having a couple of beers, and I start getting some messages that Frank's short uranium. What do you think? I'm like, it's 11 o'clock at night. Will you just leave me alone? And so of course, I went after you on text because it was fun. But no, it was pretty funny, you and I going back and forth. Look, and Frank, I do have an entity where I'm the general partner of, which you know about, and so I do, so from a uranium standpoint, I do have some insights on it and some strong views on it. Doesn't mean I'm right, but I have strong views on it. For me, Frank, if I look at where this has where it's come from, right, and everyone who is familiar with uranium will know this, and those who are hearing it for the first time may not be, but it's a commodity that is down, over about 90% now from its peak, and the number of companies has gone from several hundred down to less than 50 that are publicly traded that you could have access to, and the underlying and the market cap of the industry back in 2007, I think it was 130 billion. Back when Fukushima blew up in Japan in March of 2011, it was 60 some odd billion, and now it's 6+ maybe 7 billion because the stocks have had a little bit of a move. But when I really started focusing 3 years ago, it was a $4+ billion market cap for something that controls 12% of the world's electric grid. And, in the United States, 20% of the power is generated from nuclear power. So it really, and a solid demand story with well over $500 billion in construction right now in reactors being built around the world. So you have a solid demand story and a commodity that really is trading at a price that can't be mined profitably, even for the lowest cost producers, at an incentive margin to go ahead and do it. And you've seen some production cuts. So, when we talk about sentiment, what I was saying to you is, you're at a Vancouver Natural Resource Conference and the Sprott Conference, and there are some institutional investors there, but there's a lot of retail investors there. And my view is, while there have been some uranium bulls throughout the downturn, what's going to take this industry much, much higher is not retail investors. Some are extremely smart. I see them on Twitter. I talk to some of them, but that's not the marginal capital that's going to come in and bring these stocks much higher. That's going to be the institutional capital, simply because the size is multiples and orders of magnitude greater than what a retail investor is going to put into the companies. And from that perspective, and having an entity, talking to people on the uranium side, you're still in the dugout in terms of the awareness level. Like you, I talked to some really big hedge funds. I talked to some really sophisticated investors from around the world, and many people reach out to me through contacts I have who are curious about what I'm doing, and they're just they may have recalled uranium from years ago. They forgot the role that it plays. They haven't been paying any attention to it. And if you go back the timeline from when I really started, people started reaching out to me on this. If I just go back a year, there's a market difference in interest, but not investment. And if you're running a fund, you are not really in the business of catching a falling knife, if you will. And many hedge funds, for instance, I use those as examples, They're under tremendous pressure to perform today, tomorrow, the next day, and there are so many nuances in the uranium space that are happening underneath the surface, which is my investment style is contrarian. So I'm looking for things that are happening underneath the surface in industries that are left for dead on the long side. And when they're left for dead and there's not a lot of eyeballs on it, for instance, in uranium, there are very few research firms covering it from the sell side. There are very few institutional investors in the space. That's not a lot of eyeballs. Now, if you're running a big fund, you're running a 500, $1 billion, $2 billion, $5 billion hedge fund, the sector is too small for you at the moment to devote any real time to it. Because if you were to devote even 1% of capital to it, and you're running a $2 billion hedge fund, right, you're putting $20 million into a position. Well, that's the market cap of many of these companies. So they don't have the ability to do it right now, and they don't really want to own uranium companies. And then the really small hedge funds, the guys, running 20, 30, $50 million, if you're not focused just on uranium and you're running other funds, you don't have the resources in-house to devote the time. And when I say that is because there's so few eyeballs on it, only a handful of sell-side firms covering it, the market is by far, of anything I've ever looked at, Frank, the most opaque and complicated market there is. There's so many layers to the market. So that means you got to spend a lot of time getting up to speed. And when I said earlier, catching a falling knife, when you look at the commodity price, it's been down and down and down. Yeah, on the surface, you've seen it go from a low of $17 to $24 a pound when we sit here today, but down from 137 at its peak. So funds want to see that there's some stickiness to a turnaround. They could see the production cuts, but they haven't seen really the price move. And they're focusing on the wrong market. They focus on the spot market. Really, when price discovery occurs in the contract market, we could talk in a bit why we haven't seen real price discovery yet. But they're going to want to see a little bit more of a move and a steady move to be able to say, you know what, there's a trend developing here, and let's take a look. And so from that perspective, I think you're still in the, for using a baseball analogy, the guys haven't even come into the batter's box yet. And I think shorting the sector is like picking nickels up in front of a steamroller. There can be a time short. Can we see a 10 or 15 or 20% pullback? Who knows, right? It could be a news article. It could be anything. Anything can happen that could cause temporary downside. But I'm looking at it from an asymmetry standpoint. What's the upside potential versus the downside potential? And so when I look at that, that's what I like about the sector. I think it's spectacular.
Now, Mike, let me ask you a question now. So, and you talk, and again, I'm long this sector. So, but when I look at this market, and it reminds me of kind of like gold, where I'm seeing, what is like you said, the funds are looking for the big catalyst where they want to see prices and price discovery, prices go higher.
Yep.
But when I look at the catalysts that are going to drive this higher, these are catalysts people have been talking about for a while, outside of the supply cuts we got from Kazakhstan, right?
Frank, they have it, right? So, and people could get mad at me here now, but I don't care. The work in this sector has really sucked. When I look at going back over the years as to what was going on with why now, why in 2014, why in 2015, why in 2016, you saw a lot of bull cases, right? And it all turned on, well, Japan's going to turn online. Well, you'd be really hard pressed to find people saying, there was a lot of underfeeding that was occurring. You'd be really underfeeding, which is what happens at the enrichment plants, where they can squeeze out, I won't get into the process, but they can squeeze out some extra uranium and sell it into the market. It has always occurred, but it was occurring at a more accelerated rate because there was some excess capacity. And there was also the megatons to megawatts program, and where the Russians were de-weaponizing some highly enriched uranium into low enriched uranium, and it was coming in about 10 million pounds a year into the market, and that was ending at the end of 2013. And when that ended, though, the United States and investors thought that okay, well, that's 10 million less pounds in the market. But then that was followed on by the United States Department of Energy wanting to pay for the cleanup of some enrichment plants in the U.S. And they were bartering uranium to some contractors who were then selling it into the market. And that was putting 7 to 8 million pounds a year in the market. There were many instances of things that were occurring underneath the surface, and you weren't seeing production cuts. when you looked at so you had those secondary sources of supply, the DOE, the megatons to megawatts. You had the enriched uranium product that was coming out of the enrichment plants that was adding pressure to the market, and you were not seeing production cuts. So people were saying, well, we think Japan's going to come online. Well, you needed to be forward, not you, but people needed to be forward thinking at the time and say, okay, well, they're still spending a lot on CapEx, a lot on drilling. They're still developing in the process of licensing and permitting mines. That the utilities are not scaring anyone. You also, that they're not getting scared by that. You also had the advent of the carry trade that came into the market post the global financial crisis, and really in 2012, 2013, and you'd be hard pressed to find the bulls at the time talking about that. And the carry trade, simply, Frank, was, if I'm a financial intermediary, if I'm a trading desk, if I'm Goldman or Deutsche Bank at the time, or Macquarie, the contract nature of the market is such where utilities are concerned about security of supply. And we'll talk about this in a minute. They don't care what they pay, and all the noise focused on price right now. They'll pay what they need to pay when they need to pay it. They just want to make sure that they get security of supply. But what was happening was, like in anything, with all of this secondary supply hitting the market and the prices continuously declining, like I said, at Fukushima in March of 2011, at that date, it was $73. But in 2007, at the peak, it was $137 per pound. But it continuously declined. The utilities typically would enter into 7 to 10 year contracts, and that's where the bulk of the market would take place. And the spot from 2009, when Kazatomprom had some transfer law pricing rules, Kazatomprom being the state-owned entity of Kazakhstan, the #1 uranium supplier in the world, when they had transfer law pricing that dictated that anything that came out of the ground in an extractive industry had to be sold into a market where there's a publicly verifiable price. Well, that was spot in almost any other commodity. Well, the spot market, because of the fact that utilities want security of supply, was very small. And the big deals were taking place in the 7 to 10 year contract market. Well, what happened was the Kazakhs have low cost of production, and the way they mine, right, is lower cost. The labor is lower cost, and they're pulling it out of the mine. And they had much smaller market share than the 41% share that the country of Kazakhstan has. Kazatomprom, the state-owned entity, has 25% share of the market now, but they were in the high single digits. And as they had to pull it out of the ground, sell it into a spot market where there's a publicly verifiable price, post Fukushima, with low cost, they're pressuring the market, and you start to see the prices go down. You start to see more volumes trading in the spot market. So those utilities who had entered into contracts in 05, 06, 07, and I should say near the very peak, if you look at the trend, they were contracting like there was no tomorrow at the peak, but not down at the bottom. But they were contracting. As those contracts wore off, now you had a new dynamic in the market. You had uranium from Kazatomprom and Kazakhstan hitting the market in the spot market, where theretofore it hadn't traded a lot. And then you also had investment banks with very, very low costs of capital and good balance sheets. So what they went out in 2011, 2012, 2013 and said to the utilities, wait a second, prices are going down. We don't know where they're going to really end. Why enter into a 7-year contract or 10-year contract on those prices, on those contracts that are rolling off for you? Why don't we enter into a contract? We will go ahead and enter into a 1, 2, maybe 3-year contract. And what we will do is guarantee you price, and then you can re-up in a couple of years. The price is trending down. Why commit yourself? And the utility said, sure, yeah, great. We don't have to use our balance sheet. We'll use theirs. They can hold it. So an investment bank goes out, enters into a contract, they can either buy the uranium at the time, or they can keep themselves uncovered and hope that it goes lower when delivery comes, right? Well, that became like a drug for the utilities. So they weren't really, while their contracts were rolling off 2012, 13, 14, they don't need to enter into these big long-term contracts. The investment banks or some of the financial intermediaries, as some of the trading houses, would enter into the contracts. They might buy some on spot, they might not buy some on spot, but it changed the dynamics for a while. It was a Goldilocks scenario for the electric utilities, And for the trading firms, hey, why not? We have a low cost of capital. Let's use our balance sheet. I wasn't seeing that talked about. So you, like others, say, hey, you know, we've heard this before. Well, the dynamics have changed quite a bit, because right now you've had in the secondary market, you know, you start to get to if you think about the secondary market, they work in the enrichers who were providing a lot of underfeeding into the market. You know, my estimate could be 20 to 25 million pounds of uranium in a market that back in the early part of 16 was 170 million pounds of supply. So it's like putting a mine into the market, right? So while demand is down, they're adding a lot of enriched uranium product into the market. So you've got this supply coming, a secondary source that's adding pressure to the market. Well, they sell those things, Frank, called separative work units, is what a enricher sells it for. And at one time during their heyday, just like utilities were getting, just like uranium miners were getting much higher prices for selling uranium, they too, the enrichers, were getting much higher prices for selling separative work unit. They could have gotten 150, 160, 170 per work unit that they were selling to the utilities. Well, guess what? As everything's turned down, so has the price of SWU, the separative work unit, to now you're in the high 30s per SWU. They too have order books. Now, the cost to run an enrichment plant is very low cost. Most of the cost is upfront capital. But you're down at a point now where what you want to pay attention to is, are there a lot of cascades? That's what spins in these enrichment plants. Are they replacing them when they retire? Are they spending a lot more CapEx on that? Because if they are, that means they're happy underfeeding. It suggests otherwise. So you have less pressure coming from the underfeeding market. The United States Department of Energy just recently this year rolled back the amount of pounds that are being sold into the market, to the point where 2018 there were no more pounds being sold. In 2019 it's coming up. You're going to probably see no more pounds being sold. That takes supply off the market. The one thing though, Frank, you didn't see during the prior it's turning calls that were coming out of so many houses was the reality is supply wasn't being cut. And it's a remarkable industry, because when you look at how long the bear market was, you still saw money being spent on exploration, on mine development, and it didn't make sense. And no supply. If you have a market like uranium, which has two players control. Kazakhstan is 41%. The state-owned entity is 25 of that 41. But don't kid yourself. They're in charge of, they have a lot of influence on the other 16 percentage points of uranium being mined in their country. So between them and Cameco, think about that. You have two players controlling almost 65% of the global uranium industry. That's staggering amount of control that they can exert over a market. And then you had the other mines. Now, the average cost of a miner around the world is $50 a pound. You know, for some it's much lower, for some it's higher, but that's about the average. 45, 50, 55. You can't produce uranium at $50 a pound and sell it for 25 or 30. It doesn't work. You need an incentive margin, right? You can't sell it at a loss. So, but what happened? The miners didn't cut. They're waiting for Japan to come back online. The uranium miners fell into the same narrative as the sell side and the newsletter writers were pitching. The reality is you need supply side discipline. And that's what you're seeing. You saw that from the Kazakhs. You're seeing that from Cameco. You're seeing it from Paladin with Langer Heinrich. You're seeing Areva, and you're seeing others cut supply dramatically during a period where rates are starting to rise. So all of a sudden, those who want to enter the carry trade, when you've seen LIBOR double in a year, right? That scares you a little bit if you're a financial intermediary. There are some financial intermediaries that didn't go out and cover the uranium that they have contracts for. So now you have they're less willing to enter it. Not that they won't, but it's less attractive to them now to enter into it. So you've had all the secondary supply coming offline. You now have primary mine supply being cut, and you have real discipline starting to show during a period where contracting is starting to come. And people look at the number and they say, oh, well, that's been out there. Well, the reality is about a third of the market needs the third of the utilities don't have their uranium they need for 2020 under a contract. Now, in the past, they could have gone right to the spot market. They could have gone to, because people look at how much inventory. It must be a ton of inventory out there, right? There's a number out there of 1.8 billion pounds of uranium that UxC puts out. Okay, do the math, break it all down. What you want to figure out is how much of that, because it's at different portions of the supply chain it's in different forms and different spots, and you want to know how much is mobile. If a utility or a financial intermediary needs to go into spot, how much can they really find? And that is a tiny fraction of that inventory. So I look at all of these catalysts that are starting to come. So people say, well, where's price discovery going to come from? Price discovery in the spot market, like I said, those are financial intermediaries trading around, right? They're doing it for a small arbitrage. That's what they're trying to do. When Cameco cut McArthur River and they took 18 million pounds of uranium off the market, they have some commitments. They need to go out and start buying in the second half of the year. You just saw Yellowcake, a new IPO out of London. They took, 8.5 million pounds off of the Kazakhs that would have otherwise entered the spot market. That now goes into physical storage. So you're starting to see a market where the utilities now, 2020, a third of them need their uranium. They don't have it under contract. So you need to see price discovery in the long-term market. In the back half of 2017, you started to see some requests for proposals come out because the ordering cycle is a couple of years. It's 18 to 24 months for a utility to place an order with a mine and to get it. Well, that price discovery was starting to occur in the back half of 17 with some requests for proposals from the utilities. And they put that out there, and they wanted really low prices on those long-term contracts. And they were playing a game of chicken with the uranium miners, and uranium miners didn't bite. They can't. You can't run a company at a loss like that. So they regrouped, the utilities did, and said, okay, well, we know we need it. 2018 is going to come around. We're going to re-enter it. And then you saw Energy Fuels and UR Energy file a Section 232 petition with the Department of Commerce on the grounds of national security to ask the Department of Commerce, to ask the president, to recommend to the president that the United States utilities buy 25% of their uranium from U.S. miners. Now, what does that mean? And what does that have to do with price discovery? Well, the United States uses, give or take, let's round up to 50 million pounds a year of uranium. And if we went back probably to the 80, when the Cold War was at its peak, we were producing 45 million pounds. We had enrichment facilities. We had a nuclear fuel cycle. Well, fast forward to today, the United States produces less than 2 million pounds of uranium, right? So, and we consume nearly 50. We don't have our own real enrichment capacity. We have one conversion facility. We have the United States has an abysmal nuclear fuel cycle. Here it is, the number one bomb maker in the world, the number one nuclear power in the world, the number one nuclear power generator in the world. And it's completely dependent on foreign sources of uranium and enrichment. So the U.S. miners went to the Commerce and said, wait a second, this is a matter of national security. We want you to look at this under Section 232, which is in place for that, where industries are being disadvantaged by foreign sources and that are critical to the United States security. I can't think of anything that's really more important than uranium, it's 20% of the United States electric grid. Uranium powers our nuclear submarine fleet, our nuclear fleet. Our nuclear weaponry that needs to be upgraded. So it is a critical component to it. But what that did, and just last week, the Department of Commerce said, okay, we'll open an investigation into it. And now they have 9 months where they can do an investigation and make a recommendation to President Trump as to whether or not they recommend. Now, so what are they asking for? The U.S. miners are saying we need relief because we barely have an industry. We have a few hundred people working in it, but we have the uranium in the ground. We just can't compete with these foreign sources. So where do we get it from? Well, 95% is really 98% we import, right? Something 98, 99%, depending on the year, and it fluctuates, it changes, but you can get up to half of that from from the Kazakhs, the Russians, the Uzbeks, sources that are not friendly to the United States at any given time. It could change, right? You've got going through the Russian Duma the ability for certain materials, and it was named. They did name a bunch of them, and then they pulled the names out where they have the right to not send it to us. So here we are dependent on it. Think about being Europe with natural gas relying on the Russians. We're relying on the Russians, the Kazakhs, and the Uzbeks for up to half of our uranium needs. So, but what did that do to the market? It caused the utilities, because they have to enter into negotiations, and they indicated in 2017 in the back half they needed to, it caused them to put that purchasing on a little bit of a hiatus, because they don't really know who they're going to be contracting with. Is Commerce going to recommend Section 232 be instituted and recommend that they buy 25% of their needs, which would be about 12 million pounds? So there's a little bit of a hiatus. But when you think about the supply cuts, you think about the secondary supply that's starting to wane, you think about the contracting cycle that's coming up. To me, it's a reverse perfect storm that's starting to set up for the uranium miners. It just takes price discovery at a long-term contract where somebody steps into the market and says, okay, we're going to buy 500 or 400,000 pounds a year for 7 to 10 years, and we're willing to pay 45 to 50. Now, here's the biggest rub, Frank. In many industries, you can bring capacity right back online. Well, you've got some mines that are going on care and maintenance, but the reality is, and you could turn those on in a relatively short period of time, 3 months, 6 months, a year, that you're pulling out of the market now. But there is a natural shortfall in uranium production between actual demand and primary mine supply. And that gap has been made up by secondary sources of supply. But as supply keeps shrinking and some of these mines are running towards the end of their expiry life, you need new mine production. When you think about uranium mining, you need to think in terms of dog years. From the time you do the neighborhood negotiations and building relationships with the people in the area you want to mine, to the time you get the licensing and the permitting and the project financing and building it, you need years. You could be talking in some instances as little as 3, but as long as 10, 15 years for some of these. Those projects have been put on hold. Why? Because of the 40 some odd projects around the world, with the exception of a small handful that can matter for this cycle. People are going to say, oh, well, NextGen could produce 20 something million pounds at really low cost. Yes, they can. When that becomes a mine in who knows how many years, right? Could it be 7, 10 years? Pick a number. But for this cycle, Frank, most of these miners, and there are a few exceptions, but for the pounds coming out of the ground that matter, most of these miners need well north of $50 to produce, to even start the permitting and licensing and building and getting project financing. They need contracts in hand from utilities to go get that project financing done. And that's not happening at $24 uranium. So I think it's setting up for a multiple year deficit in uranium. Now, why? So what's going on? We need to see price discovery in the long-term market. The spot market is moving up quietly. And conversely, we're at a retail conference just recently, last couple of weeks. I was at an industry conference a month ago, well, maybe more than a month now, back in early June, with nearly a couple of hundred fuel buyers and industry people and miners and consultants. And I've been to these in the past, and there's a markedly different attitude where the awareness is in the buyers' minds that we know that there's some uranium that we need. So that's a very long-winded way of saying it. I think it's.
I was letting you go, bud. I was letting you go.
I think it's markedly different from the prior calls. And frankly, Frank, I'll be honest with you. When I saw some of these prior calls, what was it, 15, 16, yeah, almost 3 years now, I really started just diving deep into this space. And I started looking at some of the calls. And the more I did, the more I peeled the onion back. And some of the work I saw, I thought, are you kidding me? How it wasn't ready to turn. And shame on the uranium miners for not cutting production, and shame on people for not talking about the impact on the secondary market of underfeeding. Those things are starting to reverse right now. Anyway, I need to take a sip of Diet Coke because that was
Guys, I wanted to let Mike go there just to show you the type of research that he's doing. And every time I talked to him, I think yesterday, and you're in the city talking to hedge fund managers, and it seems like every time I talk to you, you're out there, and the fact that you put in this type of work where, is that sophisticated? It is. Okay. You guys have Google, you can look up a lot of the stuff that he's talking about, but this is why you're one of the best in the industry looking at things that, and you answer my question. Great. Listen, hey, people understand, like, okay, these catalysts have existed for 3 years and we have seen prices, but here's what's different now. And I think that's what people definitely want to hear. Now, I want to move on because there's a lot of other things I want to talk to. Once again, we're talking to Mike Alkin, editor of Moneyflow Trader for Curzio Research. So I want to talk about a couple positions because you've been active on Twitter talking about them. We only have about 10 minutes left, so I want to keep that in mind because I want to cover like at least 2 of these stocks, and one of them happens to be Tesla. I did a video on Tesla showing that, this is a company that's definitely going to have to raise money. And, Elon Musk says it's not going to be this year. And this is about 3-4 months ago. And Elon Musk said, we're not going to raise money this year. I said, look, maybe he's right. They don't need to raise money this year, but they're going to have to raise money January 2nd. But another person interviewed me on their podcast and wanted me to talk about Tesla. And I said, you know what? I'm not going to tell you anything on Tesla that I haven't already known or whatever, is already out there. Other than the fact that Elon Musk seems to be, going out of his mind on Twitter now, and people think that, he's losing it. So what are your thoughts? Because you're really high Tesla to the point where it's an easy short. You think it's going a lot lower. There's a lot of people on that trade. What are you seeing on that other people aren't seeing? Because we know that they're probably going to have to raise money. We see all the problems with Elon Musk, yet the stock's really been holding 300. It went to 375, but it came down. But if you look at the last year or so, you really haven't seen the hit that you would expect from everything going on with this. When, from someone who's a great short seller, who's made their living shorting stocks and knows how critical it is when it comes to the timing of this, because you could be right, but lose a ton of money in the short term. What are you seeing as some of the catalysts maybe that people aren't talking about that could really push the stock lower? Because there's a lot of negatives. And when you look at the balance sheet, it really doesn't look good. I mean, when you look at the numbers, it's pretty there for everyone to see. It's right there.
Yeah, Frank, it is. I was just having breakfast with a friend of mine this morning. He's not in the industry, but he's a sharp guy and he pays attention. And I just said, I've never seen anything quite like it in my career. And Twitter makes it different, right? Because when you go back into some of the really high profile shorts over my career, management teams CEOs didn't have platforms like this to just come out and talk. And there weren't, there were message boards for Yahoo and stuff like that way back when. But this really gives a platform for bulls and bears. And look, it's interesting. I on one hand, I applaud Elon Musk, right, for having the ability to take on an industry, for being entrepreneurial, to be able to do that and go out and raise the capital. And initially to do that, he's had a history of raising capital and selling businesses. And I certainly couldn't do that. I don't have the initiative, the drive to take on the world like that. I'm a stock analyst. That's kind of what I do, right? So hey, kudos to him for that. There have been many examples. I shared with readers of Moneyflow Trader, the Preston Tucker story going back many years ago, where had a really wonderful new age car and tried to bring it out, and it was just tough to fight City Hall, and it didn't work. In this particular case, it's the emotions that Tesla brings up are really stunning. The bulls and the bears on Twitter, which is a monster platform. Elon Musk has 22 million followers, and he has quite a bully pulpit to talk about what he wants to talk about. And what you tend to see is, look, I understand the bull case. I totally do, that this is going to revolutionize an industry. First of all, you got to start with the premise that you believe in electric vehicles, right? And I think sometimes some of the bulls I've heard, the more articulate, less emotional ones, talk about, well, we believe in EVs. Well, you know what? So do bears. So do some of the bears. I certainly do. Who doesn't want a clean planet, right? And I hope EVs work and get there. So once you get past that, you're kind of starting the roadmap that Musk laid out was start out with $100,000 vehicle, go back to the mid 2000s, generate money from that, the profits from that, or cash flow from that, turn it into a $70,000 vehicle. And those two are beautiful vehicles, right? They're out there. Everyone knows them. People who have them, I've driven in them. People love them. Yeah. So really great car. Now, but then the promise, right? Now the company was being built, though. It didn't stop there as a niche automaker. It's a mainstream automaker, right? The goal is to bring the Model 3 into the mainstream. And a couple of years ago, when those reservations were taken, I think at one point it was 500,000 reservations. It was taken for ultimately a $35,000 vehicle, which was a wonderful price point. And with a $7,500 credit, it cost somebody $28,000. That's your mainstream, and you're going to do it with really high-end robotic factories and really change the way. And so you have a lot of years of putting out a couple of really nice vehicles. You're building loyalty and going from there. It's hard to do that. It's hard to be a mainstream company. Great first mover advantage. But now you're taking on the big boys. And by the way, the big boys who hadn't been out there were on the drawing board. They were testing, they were designing, and just kind of waiting at all different price points. At the really high end price point, with Porsche coming out, with Audi coming out, with Mercedes coming out, with Jaguar coming out, and then all the way down into the mainstream car makers. But Tesla's taken on a life of its own, and for years now, the company has said, there are a few instances going back to 2011, we're not going to need to raise capital anymore. And since then, they've raised about $8 billion in capital. And I can understand the bulls, right? So now to me, when you look at the series of comments about raising capital, and then capital gets raised, from my perspective, that weighs heavily, right, in terms of how I think about what's talked about by the company. But I can understand the bulls that say, hey, once we get there, we're going to generate economies of scale, and here's going to be, and we're going to take it, and this company's going to be worth $100 billion. Pick a number. I've worked with big growth managers. I understand how they think, and that's what makes markets, right? Bulls and bears. I can't, by my analysis, not getting into the weeds here, but I can't see how that occurs. I don't think that occurs in the time frame anyway that people are talking about it occurring. The company has said it at third or fourth quarter. I think that they're going to be GAAP earnings positive. Frank, if they do, I'm not sure it's sustainable, and I don't think they can. I don't think they will be. My opinion, based on my viewpoint and my analysis, if they are, I would really need to understand how they got there. Similar to them producing five. The narrative of the company is spun that it's focus on the gross margin. We have a much higher gross margin than other car makers on the X and the S, in the mid 20s, low 20s. Other guys aren't there. Well, the what do you see? You see the best gross margins of the best car makers are at 20%. The guys who've been doing it forever, who know how to do this like in their sleep. And you have to see, there are things that are excluded. I won't, get into too much on the podcast, but there are things that are excluded from the gross margin calculation. Legally, they mention it, they disclose it, but really isn't comparing apples to apples. And then the other number they talk about is a production number. It was going to be 5,000 a week back at the end of 17, and it keeps getting pushed out. And if you just go back, there is a pattern of timelines being pushed out. And again, I understand when you're trying to change the world, timelines can get pushed out, but there's a pattern of that. And so but I think the real issue, Frank, is demand. So the company wants you to focus on the gross margin, on the number of units they're making, and when they get there at the end of the first or second quarter, they get there in these called burst weeks, where they just throw the kitchen sink at making these number of units to appease Wall Street. And but I question the sustainability of it, right? I think when you throw the kitchen sink at it and you turn everyone into focusing on those vehicles, things can go wrong. Quality can suffer. How sustainable is it? What are the costs to do that? Right? They built a tent in a parking lot. So here we went from an automated factory that was going to change the world to now, to make that number, you're building tents in a parking lot in the last month. But to me, Frank, it's the demand, because what the market really wants, I think the reservation holders really wanted that $35,000 vehicle, and they haven't been able to deliver that. Right? They're selling it at $55,000, at $60,000, at $65,000, at $70,000, depending on the add-ons you get. Well, I think there's a very limited market for that Model 3 at those price points. I think at $35,000, it could be a different story. But now you've got a spate of new competition coming on over the next couple of years, starting in the back half of this year with the Jaguar I-Pace, which has had tremendous reviews. And also these new cars, you get to a couple of $100,000, that $7,500 federal tax credit gets phased out. It gets cut in half, which will happen, I think in January, it starts to get cut in half. And now it then becomes, after 2 quarters, it gets cut in half again, while these new cars are coming out with that credit. And these new higher end cars that could challenge the X and the S are beautiful.
And like that was the thing for me too, because when I go to Consumer Electronics Show every year, last year I saw the rollout of these, all the competitors with electric cars. And now this year they're really nice, like they're beautiful. And that was the thing where that's a competitive edge that I saw that was a loss, except the companies that are making these now have, fortress balance sheets, a much better shape. And so now you're seeing the competitive landscape really, really get, it's going to be a lot tougher. And now I'm looking at a company that needs to raise money, more competitors entering the space. And when you take everything as a whole, it's pretty scary. With that said, I don't want to spend too much more time on this, because I know that you're short this and I agree with that. And I said the same thing, but would it be easier for Elon Musk, and the stock is 300? I mean, why not raise money? Why don't you just say, okay, set up, we didn't have to raise money. I mean, these guys could raise billions at 250, right? I mean, there's a ton of people that they would get. And I mean, you take a lot of the risk off the table, even if they went lower than that. Yes, the stock will get hurt, but you're taking, I mean, the big thing is you don't have the money, you have more competitive stuff coming in. You just mentioned a bunch of risks. I mean, is this him just being stubborn? Because I'm looking at stock that's 300. Why wouldn't you raise money?
It's a great question. The stock went to 370 not too long ago, right? Going into the end of the June quarter, there were tweets, short burn of the century. We are, a lot of intimation about a really great quarter, and we're going to, and they eventually got there with the 5,000 number. And the stock went from 280 to up to 370, and here it sits today. I'm not looking at my screen, but 305, 37, whatever it is. Why not raise money there? He's insistent they don't need to, right? So why not? I don't know why, because I would if I were him. I don't think it's a $1 billion that they need to raise. I think it's several $1 billion they need to raise. Mm-hmm. You look at the amount of free cash flow, operating cash flow minus capital expenditures. You're pushing $10 billion over since they've been around. $1 billion in the last quarter that went out the door in free cash flow. Now, for it to turn on a dime, that means this Model 3 really needs to just soar. And Frank, for me, again, I just don't see it happening. There are so many things from a production standpoint that are really, really complicated to do. And I'm not an auto manufacturing expert, but we've seen the timelines being pushed out. We've seen this alien dreadnought that the company calls it factory now making them by hand. And Elon tweeted somewhere in the last month or two talking about, hey, you know what? We're doing it really good by hand, or something like that. I'm not exactly sure what he said, but that was the gist of what he said. And there seems to be a lot of flux, right? And it's hard when you are, it's razor thin, the margin of error here when you're losing this much cash flow to be able to get through. I mean, that's a lot of capital that's needed. It's a capital consumptive business, while you're coming up against massive competition. Again, I go back to, are there people who love Teslas? Yes. Have I driven in them? Yes. Do I think they're great? Some of them are great. If you go on some of the clubs and read some of the boards, some of the new deliveries have really been struggling. Now, is that a fair gauge for all the cars? Probably, I don't know. But you do see, I know I've had plenty of new cars. I've never had some of the issues on a new car delivery that these are having. Is it a result of them being made in a tent in the last week? How sustainable is that? That sustainability needs to be there for them not to need this cash. Like I said, maybe they pull a rabbit out of a hat and they generate positive GAAP earnings in the third or fourth quarter. I personally don't think it's sustainable. And you do need it. Why haven't they raised money? I don't know. Because the thing that I'll tell you, Frank, is there are some equity guys, right? Like you said, it's at 250. There's a price where people will step up to the plate on this thing, right? I don't think they're going to be able to access the debt markets. I think that's going to be a challenge. See the bonds trading at 89 cents or 89 right now, right? So I don't know, right? There are some people out there that say, well, they can't because there's a reason they can't, and who knows why. Why he's not willing to? He's got amongst the bulls. They call them fanboys, amongst the really true believers. And hey, I respect everyone's opinion on what they believe. Those folks, Frank, they might finance him, and he doesn't want it. I don't know why. He's had no problem in the past over the last 8 times going out and saying, or not 8 times, but the last several times saying we don't need capital and then raising capital. So it wouldn't be too much of a departure. So I'm really not. I don't know the answer, and I struggle with sharing my views with Moneyflow Trader because you talk about what do I don't know anything anyone else doesn't know, and the thing is you try and stay away from things that are obvious, but I've not seen anything like this, and also Elon is very active on Twitter and he's very aggressive and I've not seen that type of behavior from the CEO of a $50 billion company before, and that gives me pause. Right, I've never met him. Like I said, hey, kudos to him for building this thing, and I go back to he's very aggressive. He hates the short sellers. Short sellers play a role in market, right? They keep companies in check. I've seen the bulls come out and say all short sellers are nefarious bad guys. I've been in the business 20 plus years, Frank, and I don't know any nefarious short selling bad guys. Are there a few? I'll bet you there are. Right? But probably are in the world of short sellers, just like in the world of everything. There's a couple of nefarious guys, but for the most part, in the world of the markets, there are guys doing really deep dive research, having a different point of view, and sharing that point of view. And that doesn't go over well with the Tesla bulls, and it doesn't go over well with Elon. And he really goes after them, and that gives me pause. Reed Hastings, back a handful of years ago, the CEO of Netflix. Whitney Tilson, a hedge fund manager, was very public and shared his negative view on Netflix. And he gave a presentation as to why he thought it was going to go down materially. What did Reed Hastings do? He came out and wrote an open essay to Whitney Tilson, point by point, disclaiming what he thought or disclaiming each point. And guess what? Right? It was civil. It was conversational. And he laid it out articulately. And I think, one of the things that Twitter does and people hiding behind fake names and all this stuff is it brings out just this stuff that can really, on both sides, people get really crazy. So we'll see, right? People believe in Elon. They believe he's a genius. They believe he's going to take them to a world-beating company. And there are those who don't believe it. I'm in the camp that doesn't think it's going to be able to do it at where they are now anyway, at least in this shape or form. It's nothing against the Model S, the Model X. I think they're running up against a wall here.
And Mike, I mean, you can't give Whitney Tilson a lot of credit because he actually went long Netflix, I think, in the 70s. I think he was one of and you don't really see that often when you're right on the way down and right on the way up. But the stock did come down, and I remember him reversing his course and saying, wow, I didn't understand Netflix, how big this company's going to get where they have the ability to really disrupt the entire media industry. And he went long because of that, which was cool, right? So, kudos to Reed Hastings for really laying out that point. Now, I want to get into this because, we have a few minutes left here about you have been doing this for 20 years, and now you create a newsletter, Moneyflow Trader, which I'm proud to have under the Curzio Research umbrella. And you've been short Tesla. You've actually just closed a short in Goodyear, and I want to say short, but you're not shorting these stocks to where you have unlimited risk, right? So if you were short Tesla at 315, you watched it go to 375, and let me tell you something: if you're short, you better be covering because you then go 4,000 or 5,000. You have unlimited risk. With your newsletter, you've come up with a fantastic strategy that I think is so great for individual investors, because what do we see in the market? We're seeing a market that's up for 7-8 years straight, basically, with a few minor hiccups. We know historically what's going to happen to the markets, where they're probably going to come down. So it's not just individual stocks, but if we see a market come down, which is highly likely, no matter how bullish you are, it's a great way to play it, where you provide a conservative option strategy. It's very easy to learn. And I know personally, because I see the emails all the time, how happy your subscribers are. This newsletter was launched in December. I think you have numerous triple-digit gains or close to that. I think Goodyear was almost triple-digit gain, as well as others. But talk about what you do in Moneyflow Trader, because it allowed you, instead of if you just shorted Tesla, right? I mean, it would have been really scary because you're watching the stock go from 300, 330, 350, 375. This was in June, early June, and now it's come back down. But your strategy allows you to be in this position, have a limited risk, not unlimited risk, and you're in this position for a year. So could you discuss that strategy? Because this is something that individual investors need to understand of how to protect themselves, how they can make money when stocks are going down, because a lot of people don't realize it. But if you look at the S&P 500 right now, Mike, and I don't even know if you knew this stat, there's 100 companies right now that are down more than 10% year to date. And those companies, right, to me, it's remarkable considering we're almost at all-time highs. The market is up, I believe, now this year. There's 100 companies, big name, a lot of Dow components down 10, 20% right now. And you found a way to really tap that market where you're not going to make 10, 20%. You can make a lot more than that. But discuss that strategy, because people believe, I think, from what I hear in emails, the whole market's going higher when it's really a select few stocks. And there's a lot of companies that overvalue where you can take advantage. And that's what you've been doing with your newsletter. Could you explain the strategy and how you're doing it? Because, we're off to a fantastic start and something I'm very, very proud of.
Yeah, Frank, it's a very, very basic strategy, and it might evolve over time. But it's really buying puts on companies, right? And all you're really doing is, if you have a view that a stock is going to go down, you can express that view rather than shorting the stock, which is, comes with it really, unless you're an extremely sophisticated or a professional investor. I don't think individual investors at home should be shorting stocks, because the risk is unlimited, because it could keep going higher and higher. And at some point, you got to buy back those shares, and you don't know where you're going to buy them back. When you buy a put, you're expressing a view that says, I think a stock is going to be worth a certain price or lower at expiration date, and you buy a contract. If you're wrong, the contract expires worthless. So you've lost the amount you've invested in it. Going in, when you buy a put, how much your loss can be. You might be able to get out of the put beforehand and not lose the entire contract price, but you can quantify your downside. So it's a way to express a view on the downside. And you can do it on individual stocks. You could do it on indices, right? So you could do it different ways. But it's a way to do that. And so that's been really, since we launched it 6-7 months ago, that's kind of been the strategy. Now, it's funny, Frank. I'm always early, whether it's a long or a short, because I'm contrarian, right? So I'm a deep value guy and alongside, and I'm on the short side. Hopefully you're seeing things that maybe others aren't, with the exception of Tesla, right? Where it's just, to me, I just couldn't let it go, because it was that apparent. But for the most part, sorry, if you hear background noise, I'm at home and I have kids, so I apologize. But typically you can be early. So the first couple of names we came out of the box with, they worked very quickly, and I was like, oh no, I'm glad subscribers made money, but they're not going to normally work that quickly. And so I tend to go long dated. So typically it's 9 months, 12 months, maybe in some case a year and a half, where I'm saying, okay, this is what I'm seeing happening underneath the surface, and I think it's going to take 3-4 quarters to play out. And people say, well, and then I suggest people scale into positions, right? I might say, okay, here's a company that I think is trading at X, and I think it's worth Y in 12 months. And I'm just making up an example. But rather than initiate a full position now, let's initiate a quarter of a position or a third of a position, because I'm likely early. And I think it's going to take the market a little bit of time to figure it out, if I'm right, and I will be wrong. I'm going to be wrong sometimes, flat out wrong. But it's not based on you could get the timing wrong, something I might have missed fundamentally, and that happens. But here's a time period, and we could scale into a position over time. Now, the first couple worked pretty quickly, and I thought, oh geez, I don't want to spoil people, because that's not going to happen. And since then, I've had a few that I've put out there where the stock price has gone higher. And I might or might not have said, okay, let's add to the position here, because I'm looking at catalysts. I'm looking at the news flow. I'm looking at the news flow coming out of the research firms. I'm looking at just general news flow. I'm looking at what's going on with competitors, what's going on in the fundamental landscape. So the stock price, if I'm finding a company that I think is going to have some downside in a year from now, likely the trend, not always, but the trend has probably been up, and it's going to continue that way for a period of time. It could be a couple of quarters. So the put price could go down, but we know what the expiration date is. We know it's time certain, and we know what our loss is. And I'm trying to teach subscribers how to scale into positions along the way. And that's what we're doing. And so, I think it's a good tool to use. And that we express the view through puts, and that's how we do it. And the first two that came out with Goodyear, and it was Anheuser-Busch. The catalyst, it happened sooner than I thought, and made good money right away. But then there's others where we've got a couple that are the positions are down, but I'm watching the fundamentals. I'm not watching the stock price. I don't get influenced by headlines. I don't get influenced by what moves stocks after an earnings call. If I have a 12-month or 15 or 18-month option or a 9-month option, I'm focused on the fundamentals. Very, very quick story on that, Frank. I had an analyst working for me going back several years now, and we were short a company in the for-profit education space, and we were short it in size. It was a huge position for us, and the company reported earnings, and I don't look at what the stock price is doing after earnings. I print the press release. I read the press release. That's what I focus on. What are the numbers telling me? Not what is the headline telling me, not what are the knee-jerk reactions telling me. I don't allow that to influence my decision-making. So I had this analyst come in. The company we were short reported numbers, and the stock was up, I forget, 10, 15%. And he said, "Oh my God, what did we miss?" And he was all nervous. And he was nervous because he was working with me on the position. And I said, "Never look at that again. Here's what I want you to focus on." And the stock closed in the aftermarket down, and and the stock got hammered the next day. So I'm focused on the fundamentals. I'm not focused on the noise. And that's why that 12, 15, 18, 9-month period, that's what we're focused on. And like I said, sometimes I'm just going to be wrong. I might have missed something or something. But and if I can, before the contract expires, if I think I'm wrong, I'll say, let's get out. We might lick our wounds and go on. Or I might think that at that expiration date it's going to happen. It doesn't. And, that's part of it. But to subscribers, I hopefully do a good job of explaining to them what the risks are and whatnot. But to your point, frothy market, it doesn't go up forever. And on some of these names, like you said, a lot of them underneath the surface are not doing as great as they look.
Yeah, exactly. I mean, we've seen that in the market where a lot of these stocks, a lot of very good names, I mentioned earlier in the podcast, just a handful that are down. Dow Components down 15, 20. Like, people don't realize there's a lot of stocks that are overvalued, and people just looking at the FANGs and saying, wow, these stocks going up forever and ever and ever. And again, they have amazing growth models. They're showing they have the earnings to back this growth. But when you're looking at these companies become so big, it's becoming a bigger part of the market. And when you see the Walmarts, the Caterpillars, the Procter & Gambles, the Kimberly-Clark's down, 10%, 15%. This year, it surprises people, but you can make a lot of. You're not going to make 15%. You're going to make a lot more than that. You're betting on that this downturn is going to happen on this stock within a year period, and it's just been a great strategy. And I know you're making subscribers money, which again is the greatest thing on earth, because I know you get those emails and you tell me all the time how cool it is, and you really, it's hard not to get attached, right? It really is. So
that's why I do this. I try and just to help people share with my whatever insights I have.
Yeah, and it's been going good, Mike. So listen, we covered a lot today. We covered uranium. I'm going to go out on Twitter and say that I'm definitely short uranium. This is where you can come down here. But no, it's just funny to get all that feedback when I just made like a simple comment saying, hey, I'm investing in uranium. I'm just, but it's great that, I could talk to you and say, hey, this is what I'm hearing. And you're saying, well, the institutions aren't in, so not really. But and we covered a lot of things, even with your newsletter and Goodyear and especially Tesla. So, Mike, listen, thanks so much for coming on. I'm so happy you're doing your podcast, guys. Make sure you give it a listen and go on iTunes and find Michael Alkin, also his Moneyflow Trader newsletter. Great stuff and great.
By the way, Frank, you've done this 600 and some odd podcasts.
It's more probably like 2,000, 3,000. And that's just Wall Street Unplugged, which I started when is it, probably 3 years ago. And now, I've been doing this for 10 years. And, it was The Real Story. Then I think we had I forgot what the name was even when I was at Stansbury, but man, and I don't know if you know this, Mike, but when I was at the street, I used to do a podcast for an hour every single day.
Frank, well, you know what? There's one record I think will never be broken again, and that's Cal Ripken's consecutive game streak of over 2,000 games.
Yeah.
And I got to think that your streak of never missing a week of what did you say, 2,000 podcasts? I thought it was 600. I don't see that ever being broken. So
I appreciate that, man. Yeah, I do.
Pretty amazing. Pretty amazing.
And I'm glad you're on board the podcast train, man, because it really is cool. It's a way to really reach out to investors and subscribers and stuff. So listen, thanks so much for coming on. And I'll talk to you soon, buddy.
All right, man. Thanks, pal.
Okay, guys, great stuff from Alkin. There's Moneyflow Trader newsletter. We're going to provide a special offer for podcast listeners only. Again, if you're looking for a way to hedge your long positions, make money on stocks that fall in value, and I'm talking conservatively, not going short. It's truly amazing newsletter. It's a product I'm really proud of that we launched at a really good time. So I know some of you option experts out there and buying puts, even long dated puts. Look, the strategy, you probably use it, but most individual investors don't. And I want to bring this strategy to them. Because if you're one of those, Mike provides a real easy guide on how to use a strategy. And he has just not only the guy, but he has 16 different things that he looks at for every stock. And if it triggers like 5 or 6, and it's pretty cool just to see what he's looking at since he's a forensic accountant before he really shorts a stock. So it's a very educational product. You're not just going to get the typical, hey, here's my pick and here's a nice story. No, we're going to make these products educational, do videos for you, and actually teach you what we're doing, what we've done for the last 20, 25 years, and learn from the mistakes that we made. And, Mike does a really, really good job. We've got some great feedback. And that's something I'm going to require from every one of our editors and every product that we launch going forward. But he has an amazing track record, over 20 years experience working for hedge funds as a short seller. And thus far, Mike's done a great job for his newsletters. So I want to see all of you enjoy that success, especially since the conditions are really perfect. And the markets have been up for 8 straight years. And listen, if they fall, which is likely if you look at the history of the markets, right? I mean, it's probably going to happen within the next few years. We're going to see a market pullback, which is normal. A lot of his positions do really, really well. So I'll be sure to send you a link over the next couple of days with a special price. If you're interested, cool. If not, no worries. Again, my goal, 100%, the top goal is to make you money. And right now, it's just, I really believe this is the perfect product for the perfect market. And I think you'll do really, really well. So, okay, guys, that's it from me. Thanks so much for listening. And I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.